All right, let's get right into it. Today, we're conducting what I'd call an institutional autopsy of the enterprise software company Sprinklr. We're going to cut through all the noise, all the hype, and focus only on the hard numbers and the underlying reality of the business.
Now, this quote right here, it's pretty much the key to this whole analysis. See, unlike a consumer startup that can just flame out overnight, big enterprise software companies, they can look stable for years. They can hide some really deep problems behind those sticky, long-term contracts. So our job today is to peel back that layer of false confidence and see what's really going on underneath. Okay, so first things first, why does a company like Sprinklr even need to exist? This isn't some cool new gadget. It's what you'd call a necessary machine. It's a solution to a really messy, chaotic problem that huge corporations absolutely have to solve. There's no getting around it.
So, to really get a handle on Sprinklr, we need to be crystal clear on what real customer experience management, or CXM, actually is. And I'm not talking about those simple social media dashboards or some vanity marketing tool that just makes pretty charts. No. Real CXM is about knitting together every single way a customer talks to a company, managing risks that could literally destroy a brand, and enforcing ironclad rules about who can say what and when. This is mission-critical stuff.
And if you're wondering why this is such a big deal, well, here it is. Think about a global brand like Nike or Microsoft. We're talking about millions of public interactions every single day. One bad tweet, one wrong customer service reply can explode into a global PR nightmare, or even get regulators knocking at your door. At that kind of scale, you just can't manage that with people and spreadsheets. The system just breaks. This kind of software isn't a nice to have. It's about survival.
At the end of the day, when you strip away all the fancy marketing talk, Sprinklr is really selling one thing: control. It's designed to take the absolute chaos of modern public communication and put it into a structured, governed, and predictable system. It's all about reducing risk. That's the core of it. Okay, so we've established the business exists for a very real, very important reason. But this is where our autopsy gets serious. This is where we need to start looking for the cracks in the foundation, the things that could really challenge its value in the long run.
And that leads us to what is honestly the most important and maybe a little uncomfortable question we have to ask about this company. Is the revenue Sprinklr generates a durable, reliable stream from happy customers who love the product? Or is it more of a hostage situation where customers only stick around because leaving is just too painful? The answer to that question changes absolutely everything.
So let's be really clear about what we mean by hostage retention. This is what happens when a customer renews their contract, not because they're getting tons of value, but because the pain of ripping out the software and retraining everyone would be a complete nightmare. It's just a bigger headache to leave than it is to stay and keep writing the checks. And that can create a very dangerous illusion of health.
So where do you see this hostage retention pop up in the numbers? Right here. On one hand, you have logo retention, which looks great. Customers aren't leaving in droves. But then you look at net revenue retention, or NRR. And that tells you if the customers you already have are actually spending more with you over time. Buying more services, adding more users. And for Sprinklr, that number has been inconsistent. It suggests customers are staying, but they aren't exactly rushing to buy more. And that puts a real ceiling on your growth potential. All right, now we need to talk about what is, for me, the single biggest red flag in the financials, and that is stock-based compensation, or SBC. From an institutional standpoint, this isn't just another line item on an expense report. It's like a silent tax on you, the shareholder, slowly watering down your piece of the pie through dilution.
And you can see the story pretty clearly on this chart. While it's getting a little better, SBC as a percentage of revenue is still way too high, hovering up around 25%. Just for context, a really well-run, mature software company is usually aiming for something under 15%. This isn't just some accounting detail, it's a major reason why their operating and net profit margins just haven't looked great, even with revenue going up. For a patient investor, this constant dilution is a killer.
All right, so we've laid out the problems, we've seen the cracks, so now let's talk about the cure. What absolutely has to happen for this company to survive and create real, lasting value? This really comes down to a battle between discipline and long-term failure.
Look, the to-do list for management is actually pretty straightforward. Number one, they have to get aggressive about cutting that stock-based compensation. They need to put shareholders first, even if it's tough on morale in the short term. Number two, simplify the platform. Make it so useful that it sells itself, instead of just selling a big, complex thing. And third, they have to figure out how to turn those hostages into true partners who actually want to spend more money.
And this scorecard right here really puts it all into perspective. You know, you look at the numbers and you see sales have been growing at a decent clip, maybe around a 20% compound annual growth rate over the last 3 years. But profit after tax, it's been kind of flat. That's a huge disconnect. And that's why you see things like return on equity and return on capital employed stuck down in the low single digits. For a software company, that's just not where you want to be. The journey to being a truly efficient company is far from over.
When it comes right down to it, this is all about a shift in mindset. The company has to switch from that grow the platform at any cost mode to a protect the shareholder mode. That is the fundamental transition that has to happen to unlock real value. And honestly, they're not quite there yet.
All right, this is it. The final section. This is where we deliver the verdict we promised. Based on everything we've just gone through, what is it? Is Sprinklr a disciplined survivor in the making, or is it just a value trap waiting to catch unsuspecting investors?
But hold on, before I give you that final verdict, we have to establish our ground rules, our kill switches. These are the hard, bright red lines. And if any of these tripwires get hit, for a disciplined investor, it's game over. You get out. No hesitation, no second thoughts.
So what are they? Here's the list. First, if that stock-based comp number stops getting better for, say, 4 quarters straight, that's a huge warning sign. If their free cash flow, which has been improving, suddenly dips back into negative territory. If we see management start spending wastefully just to chase growth, or if the platform actually gets more complex instead of simpler. Any one of these is the signal that the discipline is gone and it's time to go. Okay, so with all that said, here's the verdict. The verdict is conditionally investable. And I chose that word conditionally very, very carefully. This is not a blind bet. It's not a buy and forget it kind of stock. It's a company that could be worth a measured position, but only, and I mean only, with strict ongoing monitoring. And this is what a disciplined approach actually looks like in practice. You don't just jump in with both feet. You start small, a little tracking position. Then you wait for proof. You only add more capital when management proves, with their actions and their numbers, that they're getting more disciplined. When SBC comes down meaningfully. When cash flow is consistently positive. When customers start spending more again. You scale in based on proof, not on hope. And I need to be absolutely crystal clear about this. The potential returns here are completely capped unless management's behavior fundamentally changes. Without that hardcore discipline on costs and a real focus on delivering value, this stock is probably going to go nowhere, even if the business itself survives. The upside here has to be earned by management. It is not, and I repeat, not a guarantee. Which really leaves us with one final big question to chew on. The business model itself, it isn't broken. It solves a real problem for some of the biggest companies in the world.